George Lucas. The person who is Indiana Jones, Harrison Ford. And the person who is the glue to all 5 of these films that gave us all of our rhythm and all of our melody, the great maestro, John Williams.
So this came over from the Hollywood Reporter. The headline is, Disney gets stock price target cut by more than $30 from Wells Fargo analyst. All right, that's the Hollywood Reporter. Headline, Disney gets stock price target cut by more than $30 from Wells Fargo analyst. And this is what he says. Approaching calendar year 2024, we think the longer-term direct-to-consumer earnings margins story begins to emerge as the key reason to own Disney in duration, writes analyst Stephen Cahill. Wells Fargo analyst Stephen Cahill cut his stock price target on the Walt Disney Corporation by more than $30 on Tuesday, but stuck to his overweight rating, predicting that investor focus would, over time, shift from near-term challenges to longer-term upside. His commentary comes at a time when analysts have been intensely debating the outlook for Disney amid various challenges, from cord-cutting and streaming losses to advertising market clouds and questions about the company's future business mix, which is important, let me tell you. To us, Disney is the most interesting stock in the media, an IP powerhouse down on its luck at a COVID price and historically low multiple. He wrote, presenting deep dives into the investor bull and bear cases. He averaged the 2 scenarios for a new stock price target of $110,000, down from $110, down from $146 previously. So that's the story. All right, other elements of the bear case include Disney doesn't spend as much on content as investors think, $10 billion excluding sports participations, and the concern that ESPN will not transition well to streaming, creating a long-term earnings per share hole, the Wells Fargo expert highlighted. A final worry has to do with CEO Bob Iger's recent mention that the Hollywood giant could sell linear TV networks, including ESPN. Cahill summarized it this way. Disney won't be able to successfully divest non-core linear. In contrast, the bull case for Disney focuses on its remarkable IP library with strong appeal to kids and families, which make up roughly 2/3 of core Disney Plus and subs. Cahill highlighted. In addition, the streamer is now about price/margins, not sub-growth. And he argued that Disney Plus is massively underpriced versus Netflix on dollar per month average revenue per user, ARPU, per $1 billion content value, including Disney Library, so we're bullish on price hikes. Other causes for optimism are the exceptional Disney parks, experiences, and products, DPEP, business, the planned sale of linear TV assets, and predicted DTC break even by the third quarter of fiscal year 2024, along with what Cahill estimates to be $1 billion in Hulu cost synergies after Comcast puts its 33% stake in the streamer to Disney. He even sees an opportunity in the recent heated headlines about Disney's carriage dispute with cable giant Charter Communications. ESPN equals net operating income driver plus Charter dispute speeds change. K. Hall expressed his take in an equation form. His math: there's arguably around 60 million plus sports fan households based on viewership of major sporting events. When ESPN had about 100 million subs in 2015, he estimated non-sports fan subs of around 40 million. So ESPN's affiliate fee was revenue maximizing, but under pricing sports fans. K. Hall explained. Now, non-sports fans are less than 20% of pay TV subs, so it makes far more sense for Disney to launch a DTC and price discriminate to the more price inelastic sports fan. The analyst expects an early fiscal 2025 ESPN streaming launch and trough ESPN EBITDA of around $1 billion in fiscal years 24 to 26, down from about $4 billion in fiscal year 2021. Another one of the key arguments is that the Charter dispute not as material for Disney as bears think. Explain K. Hall. We don't disagree with Charter's assessment that the pay TV ecosystem is broken with bundles and fee structures that aren't consumer friendly. We're also not convinced that this is a pivotal moment for Disney. For one, if there's persistent Charter blackout or perpetuity drop of Disney's content, then subs will likely reappear on other TV services, including Disney's streaming services, Hulu Live TV, YouTube Live. Given the availability and choice in content services today and their ubiquity, it does not stand to reason that a drop by Charters means viewers will remain unsubscribed, especially sports fans, during football season. Additionally, he suggested that Disney likely accounts for a bigger part of viewership than Charter has indicated. Overall, the Wells Fargo Analyst is taking a longer-term view on Disney, taking the best from each argument, bull and bear. We think the short term is more risky due to DTC subs churn on price hikes. Charter headlines getting Hulu done and macro for parks. K. Hall concluded. Approaching calendar year 2024, we think the longer-term DTC earnings margin story begins to emerge as a key reason to own Disney in duration. He also shared why he is sticking to recommending Disney stock with his overweight rating, explaining, we think the bad news is mostly baked in. So, okay, everybody, this is kind of a big deal, and it does affect literally every part of the Walt Disney Corporation. First off, investors are still bullish on Bob Iger. So, unless something really immense happens, Kathleen Kennedy is not going to get her wish of seeing him get fired. Nor will she see her wish of seeing the board get fired. That's not going to happen. Because ultimately, Wells Fargo, Vanguard, Nelson Peltz, etc., are the ones that actually decide who runs Disney, because they are the big dogs with the most voting shares. And right now, I think for Star Wars fans, this guy right here, Bob Iger, is our best bet. And in my estimation, and like I said, unless something really untoward happens, he's there till 2026. And there you go. They're letting him have his chance to fix what he broke. And really, when you look at where the Wells Fargo analyst, K. Hall, put his be-all, end-all stock price for Disney, in this climate right now, $110 per share is not bad. Okay. It's not where it was, but the rule is if you're playing with the stock market, you're in for the long haul, not for the short money maker, okay? This is why people get stocks, okay? And we're in a down cycle right now all across Hollywood. Barbie's doing well, and actually I think the box office is up a little more than it was in recent years. But again, Disney has not had a hit. And I mean, I hate to break it to Kathleen Kennedy, but Indiana Jones and the Dial of Destiny did not do well, okay? That's the truth. That's the bottom line, okay? And it really goes to show what has to be improved with content, because they are an IP powerhouse. They just have people that are leading the parts of the company that are, dare I say, dunderheaded morons, okay? All right, and I mean that in every way the word means, that the phrase is dunderheaded morons, okay? So, if Kathy thinks she can wait them out by overpricing the house they're selling, no, okay? Because look, in my opinion, that house is not priced to sell. And it's either she's trying to wait the board out to fire Iger, and she thinks she might get a better deal, or she's so pretentious that she actually thinks someone's going to pay double what she paid for it, when it's probably worth about $12.5 million. If you look at it priced comparatively to other properties that are very similar, they're not priced nearly as grandly. There's only one that I've seen that's priced for like $20 million, but it might as well be Sleeping Beauty's castle. It's that big. Okay, that it's really big. I mean, 4,000 square feet of that place might be a wing of that place, if you understand what I'm saying. Anyway, I wanted to get this story out because it's important. And I like what the guy had to say. It's also a lesson in patience, and patience is a virtue. So for fans out there, you got to dance with the boy that brung you. And Iger and Chapek both got us to this point with Kennedy. Now it's just waiting for her to decide when she's done and to put in her resignation. Okay, which is, look, everything Sparrow has said is pretty much they want her to go on her own. And, there's only so much humiliation that a person can take before they're like, okay, fuck it, I'm done. She'll still get executive producer names on, some of the streaming shows, and that, it's basically, this is another indication that Iger is doing well, considering, and that Wall Street trusts him. Okay. This is Steph signing out. I'll see you around the galaxy.